Hello, everyone, and thank you for joining us today for our quarterly asset allocation webinar. I'm Phil Huber, Head of Portfolio Solutions at Cliffwater. Today, I'm joined by Cliffwater's CEO and CIO, Steve Nesbitt. One of the reasons we get such great attendance for these quarterly webinars is that Steve is pretty efficient with his prepared remarks, leaving ample time at the end to answer whatever asset allocation questions are on your mind. So please feel free to submit those questions throughout the presentation, and we'll do our best to get to as many as possible in our allotted time. One last note, this webinar is meant to be a research-focused webinar and not specific to any Cliffwater funds. You're welcome to submit questions related to our funds. Just be aware that depending on the nature of the question, we may not be able to address it live on today's webinar, but we'll be sure to follow up with you shortly thereafter. With that out of the way, Steve, you are welcome to begin.
Thanks, Phil. My first slide, I'm showing, illustrating monetary restraint. Even though we've had a cut in Fed funds rate, half a percent in September, we're still in basically the same position as we were before the Fed cut rates. So on this chart, I'm showing in red the trailing 12-month rate of inflation. If you look towards the right-hand side of this graph, it continues to go down. Trailing 12-month was 2.60%. In terms of Fed funds rate, after the 0.5% cut, we're at 4.83%. That differential, which represents the real rate of interest, is 2.23%, basically the same as a quarter ago. So even though the Fed's cutting rates are cutting them in unison with the reduction in inflation, so we're basically dealing with the same level of monetary restraint as we did last quarter. In terms of fiscal policy, so on the read in the journal today, $1.8 trillion deficit for fiscal year 2024. A big picture is we've basically in a new higher level of fiscal deficits, which are projected to continue unabated into the future. Basically, those deficits represent about 1% of total GDP. So we're in a fiscal stimulus regime, which basically offsets in some way the monetary restraint that the path the Fed has been on over the last couple of years. The net result for the economy, real GDP growth, there was a good print recently, 2.5%. I can't remember the exact number, but basically we've been on this up and down on this 2% real growth path. It's good. It's not great. I think we generally are targeting about 2.5% to 3%, but basically not bad, which has created altogether a good background for the financial markets. I'm going to switch in a second here to the fourth quarter and long-term forecast for the different asset classes. But just as a reminder, there are really four elements to valuation. There's the current cash yield, cash flow growth, positive in the case of equity, negative in the case of credit, potential change in valuation, change in interest rates or changes in PE multiples that can affect return. And then finally, manager alpha for those asset classes where the focus is on managers creating return. There may be a manager alpha component or forecast in terms of total return. Jumped one ahead. One thing I do want to say, I've been putting this graph in for quite some period of time on my quarterly calls. It's what I titled "The History of the U.S. Capital Markets." but subtitle could easily be "Don't bet against the U.S. stock market." So a couple observations here. This goes back basically to where credible data is available for the S&P 500 just before the Great Depression. But the compound annual return on stocks is pretty linear, at least on a log scale, upward sloping compound annual return, just a little above 10%. That steady path is sometimes interrupted by a sideways movements as we had in 2000 to 2010, had that in the 1970s and obviously during the Great Depression. But so there can be serious decades of zero returns for stocks. But if you look long term, it's really an incredible. It speaks to the incredible resilience and growth of the U.S. Economy. I will say the 10.4%, it's difficult to extrapolate that going forward. Of that 10%, you could probably knock off 1% because of a upward movement in PE ratios. I don't think anybody is forecasting further increases in PE ratios. Secondly, inflation rate has been higher over this period than most project going forward. So if you do those adjustments, basically you get a 9% per annum return for stocks. And I mention that because I want to compare that edited 9% against bonds, which the compound annual return has been 5.3%. Arguably, it's a difference of 3.5%, maybe a little above 3.5% differential. So just stick that in that number, 3.5%, in the back of your head, because I want to come back to that in a few slides, because the spread on a projected basis had been much lower, more on the order of 2%, and that has changed. And I want to reference that comparison again in a few slides. A lot of meat on slide 7. Let me just try to summarize here. First, we divide the asset classes into different groupings: equities, rates, which basically mean asset classes largely impacted by interest rates; credit, alternative investments, and then other financial indicators. Let me start here, focusing on the columns. So I'm showing in white the third quarter return, the year-to-date return, 9 months ending September 30. And then I'm showing our long-term expected return. So this is roughly a 10-year forecast. And then I'm showing the forecast assumptions, or basically how we formulate those expected returns. I might say for a number of these asset classes, we use a more sophisticated model than what's shown here, but the simplification is not too far off. So in the case of the S&P 500 or non-U.S. stocks as well, both had good third quarter, 5.9, 7.7 respectively. Year to date has been incredibly good year, risk on year for the S&P 500. As in past years, non-U.S. stocks have lagged pretty significantly. Our long-term expected return, actually, despite these strong returns, excuse me, our expected return actually has gone up quarter over quarter. We're showing 6.8. We showed 6.7% last quarter. Despite the increase in stock prices, earnings increased at a greater rate, which caused us to increase our expected return to 6.8%. And in terms of the rate categories, those asset classes affected most by rates. Again, risk on quarter, which basically helped the 1-year returns. The drop in interest rate caused mid-single digit positive returns for most of these rate-oriented asset classes. As a result, obviously coupons don't increase. What happened was our expected returns have gone down pretty significantly, about 0.5% over the quarter. I'll talk more about that shortly, but basically it contributed to wider spreads between the expected returns on equities and expected return on these bond asset classes. Quiet in terms of the credit markets. The Morningstar LSTA index up 2%, 6.5% for the year, basically running along at coupon levels. High yield bonds have done a little bit better, largely because they're fixed rate, have some duration risk, which has helped that asset class vis-a-vis the Morningstar leverage loan index. Moving on to alts. Big quarter for REITs. I'll talk more about that later. Up 16%, reducing the expected returns significantly. Now we're forecasting a little under 6%. Hedge funds have been doing okay. 1.1% for the quarter, 6% for the year. Basically, we're expecting mid-single digit, maybe a little bit better returns for hedge funds on a go-forward basis. Commodities, basically not much going on there. MLPs got their bump earlier in the year in the second quarter. I'm going to talk more in a moment about these private asset classes, but if you look at private equity, private real estate, private debt, these numbers are 1 quarter lagged. So they're 1 quarter and 9 months, but they're lagged a quarter ending June 30. Private equity, basically modest returns. I'll talk more about that later, but they're positive and they're decent. Real estate still struggling, down for the quarter and down for the year to date. These are unlevered numbers we're showing here. And private debt, again, chugging along at its coupon level, 2.6% for the quarter, 8.8% for the year. A couple things in the other category. Oil is dipping down from a high level, but so far this year is edged down. Gold is up pretty strongly. Probably a number of factors contributing to that. The U.S. dollar has declined, so that may be part of it. In terms of GNP, basically, I talked a couple slides ago about that 2% rate that we've been realizing over the last few years. The estimates now, the estimate for Q3 is a kick up to 2.5. For the year, people are expecting 2.4%. That comes out of the Atlanta Federal Reserve Bank. And CPI has come down significantly for Q3. And again, we don't have September numbers, so this would be the 3 months. It's 2 months ending. This would be, July and August. I annualized those 2 months, seasonally adjusted 2.1. So basically, our current run rate is a pretty low inflation number. And year to date, annualized January through August is 2.6%. So that inflation number, the run rates have come way down. I know if you look trailing 12-month they're somewhat higher, but right now the run rates look like the Fed has um, had some significant achievement here. So over the last few quarters, for most of the year, and I think going back into last year, I had said that, hey, the last 10 years, from a tactical point of view, overall asset allocation, we had leaned into equities. We had said that this spread between expected return spread between stocks and bonds favored stocks. Okay. And if you remember when I in that graph, I think it was slide 2 or 3, or no, excuse me, it was slide 6. I talked earlier about a 3.5% normalized spread historically. It had been much wider than that. So if you look at the shaded area shows the spread between the blue line and the green line, stocks and bonds, and it had been 4 to 5% for most of the past 10 years. And then as the Fed increased interest rates, all of a sudden that spread declined. Last quarter, it was 2.32%. So it was really small compared, almost half the historical average. And I've been saying this year with that smaller spread, hey, maybe it's time to shift from equities to lean into fixed income, or at least be neutral. And this last quarter, the spreads widened. They didn't widen in what you might think the usual way, with stocks going down. They widened in bond prices going up, yields going down. So that increased the spread. Today, that spread is 3.01%. So it's still below the 3.5%, but we're much more in balance, in our opinion, than we have been in over the last year and a half. With that, so I'd like to spend the rest of my time focused on private equity, private debt, and private real estate, because when I read the press, or even others, there's seems to be confusion about in terms of short-term returns on those asset classes. So I thought I'd try to bring some, at least our perspective on that. So first of all, I'm going to start with private equity. I sent out a paper a couple of days ago on private equity. There's been a lot of focus on private equity, both because it's growing as a asset class, both institutionally and in the wealth channel, but also because the returns have been more single digit rather than the double digit in the public equity market. So I'll get there very shortly. But I sent out a paper that basically looked at private equity performance against public equity performance over long periods of time. And I do that over rolling 5-year periods. So let me explain this graph if I could. The vertical axis shows annualized 5-year return, and the numbers plotted on the vertical axis are 5 years ending individual years. So we start 5 years ending 2005, 5 years ending 2006, et cetera, up to 5 years ending 2023. Focus on the blue line. So the heavy blue line shows a performance of private equity. I won't go, you can read the paper, go into what the database is, but basically private equity returns, 5-year rolling private equity returns. And I just wanted to note a couple of things. One is they're all positive, okay? So no one's lost money in private equity on average over any 5-year period over this almost 25-year period. The second is, if you look at the diamonds, the diamonds are the equivalent 5-year returns for public equities. Okay. And notice that those diamonds always fall below the blue line. Okay. With one exception, that was the 5 years ending 2024 when there was public equities outperformed by a small amount. And that was the financial crisis rebound period. But other than that, the probability when you're investing in private equity, and we've said this, I've been saying this for 40 plus years. Basically, you should expect a delta between 3 and 5% above public equities over a reasonable period of time. If you take an average of these 5-year periods, that delta is 5% over public equities. My next point is that I'm showing here the percentile ranges, 5-year percentile ranges, the 25th, 50th, the 50th being the median, 75th. Okay, so 50% of the observations are between the dashed lines. And then I show the minimum and maximum. So what I see is good news is that if you're an investor in private equity, okay, and you have a diversified portfolio, even if you're investing in one fund that is diversified across GPs or managers, you're going to be fairly close to the median. Okay, so you're at least within 2.5% of that middle. So it's not like you have a good chance of achieving the median, even though you might want to do better than the median. There's a good chance you're going to be pretty close to it. The bad news is you can mess up. Okay, you can pick a bad manager or bad fund. That would be the solid line at the bottom, the gray line, and in which case you're going to be at or fall below public equities. It's not going to be by a lot still, except for the 5 years ending 2005. You're going to have positive returns, but it's going to be it's going to be hard to demonstrate value added vis-a-vis the public markets.
Hey, Steve, sorry to interrupt you there, but I know we usually leave questions till the end, but one came up wondering about net of fee private equity returns, and it might be worth just elaborating a bit on what exactly is being measured here in terms of the private equity return stream.
Private equity, we always show net of fees. Okay, so and that's true with private debt. Numbers we show there, numbers we show for both those asset classes are always net. If we show gross, and in a couple of cases we show gross, I'll mention that explicitly. But these are all net of fees. Okay.
Thanks, Steve.
Yeah. So let me focus on more short-term valuation. Okay. So this is a graph, more recent. So this is a cumulative growth of $1 graph for public versus private equity, because I want to show the issue. There's been a divergence, and I want to explain that. So in blue, this is a index, different data set we use, but this is the Cambridge U.S. Buyout Index, okay, and net of fees. And I'm contrasting that with the Russell 3000 index. So it's apples to apples in the sense that it's U.S., okay, and private equity versus public equity, really over a short-term period of time, the last 5 years. And I started at December 2019 because the markets were pretty much calm and in equilibrium back then. In other words, if you look back a year, look back at 2019, 2018, there weren't a lot of anomalies. So it's a good starting point. So we had down, up since then. The down was COVID, which remember basically concentrated in a quarter. And then we had the most recent, the rise in interest rates beginning in 2022. And I apologize, I just noticed an error. That vertical line says December 31, 2019. It should say 2021 to demark when interest rates started to really jam up. So I apologize for that. But my point was the first thing we should observe is that over any period, whether it's 1 year, 2 year, our expectation is to do 3 to 5% better than in privates than in publics. And if you look at the endpoint, the endpoint for private equity U.S. buyouts was June 30, 2024. So if you look at those diamonds on the right, sure enough, private equity has done better than public equity by about 3 percentage points. It's not the 5. I will say generally in strong up markets, which this falls into, the delta is not as high, but it's a healthy 3% differential nonetheless. But notice in the intermediate period, because of the demand for liquidity during risk-off periods, like during COVID or 2022, basically public stocks fall more than private stocks or private equity. That's to be expected. I've also said in the past that we don't see a lot material problem with private equity. At most, there's a 1 quarter lag in valuation. So if you notice the break point in 2021, where that vertical line is, we had a dive in public stocks where private equity stayed roughly flat. You could argue that was a lag in valuation, but it doesn't persist. At most it's a 1 quarter event. So overall, people have been, I'll just say, people have been focusing over the last year and have said, oh, gee, public equity is doing better than private equity. Gee, trying to impute some big meaning to that. There is no, this is following the trend that we've seen really for 40 years, where it's public equities are in a catch-up, but they never fully catch up because on average there's a 3 to 5% delta on privates versus publics. Okay, let's go to private versus public debt. Okay, something I think most of you are familiar with. Here we're using the Cliffwater Direct Lending Index. That is gross of fee. Okay, but basically, I will say that most products, including our own, use a little bit of leverage, add on the fees, and basically their performance is very close to the Cliffwater Direct Lending Index, CDLI. So let's look at that pattern. Basically, because of the lower risk in both leverage loans and the CDLI, these paths are smoother. Okay, the leverage loan index did fall during COVID. Okay, and so did our index. So there was no lag in terms of private debt valuation. Also, if you note in 2021, the drop in valuation and the LSTA, the direct lending index was flat. Actually, I think it was just a little bit negative. But again, this is a very short-term impact here, and then there's convergence. But again, never convergence to the private return, because long term there's a significant delta. In this case, 4%, but generally ranges between 3 and 5% delta between public and private debt. Okay. Let me go to finally real estate. Here's where you can argue you have private valuation issues. So again, I apologize for that date, December 31, 2019. It should say 21, but basically the REIT index. Okay, there's a public proxy. We're using the NCREIF REIT index. The FTSE NAREIT index. That fell almost 30%. Okay, no change in the NCREIF index, and then the NAREIT rebounds, and the NCREIF index seems to capture the upside, but not the downside. Then we had a drawdown again. We had a little bit more of a decline in the NCREIF index, but I can see why someone who's investing in private real estate is skeptical about valuations, given this pattern of return. I don't see it in the case of private debt or private equity. Important point I wanted to also make is, if you look at the far right-hand side, the diamond. So basically, as of the end of June, they matched up. Okay, this is important because if you look at long-term returns of REITs, publicly traded REITs, and private real estate, as measured by this NCREIF index, basically they earn the same return over a long period of time. Okay, and so here we have I've been saying for the last couple of years, you should be cautious about investing in private real estate, particularly with legacy values. I don't know. I think I can no longer say that with conviction. Basically, it looks like the public valuations have caught up with the private valuations, and particularly the very strong quarter. You see the orange line shoot up. The very strong quarter suggests that perhaps equity real estate is attractive now vis-a-vis public real estate. I do also, let me just back up, if I could, a couple quarters, because I also wanted to mention, I was talking about private versus public equity. Notice the strong return on public equity for the third quarter exhibited here in the orange line. That suggests that private equity probably has some tailwinds in terms of valuation. So again, I hope that's helpful in explaining the short-term numbers you've been seeing on public versus private alternatives. Just key takeaways. We're in rough equilibrium, I think, in the capital markets. Private debt still seems to be the most attractive, but private equity, particularly with the pickup in the S&P 500, seems to be a strong buy as well. I've been negative last quarter. Basically, I edited last quarter. That's what these crossouts are. So I said last quarter, real estate problems likely to continue. So I crossed that out, and I'm saying maybe in the past. Okay, so from a technical point of view, I think real estate may look interesting again. Haven't changed my opinion on non-U.S. stocks. I said public bonds regaining their value proposition. I think they've given it back. So I no longer believe that public bonds are a buy. It's basically a neutral now. And again, from a balanced portfolio, no change from my recommendations last quarter. So let me end there, Phil, and see if there are any questions.
All right. Thanks, Steve. Great stuff as always. Why don't we start here? If we want to rewind a few slides to the initial private equity performance chart that you had. We have, I believe it's a Russell 3000, MSCI ACWI split of 70-30 is what we're using for the public equities benchmark there, and that's designed to be reflective of the actual PE investments of the constituents inside of our composite there. Can you speak to, how does that look differently if we were to compare it to something like the S&P 500 or a US only public stock index?
Well, you could probably, if you just did it against US stocks, whether you use the S&P 500 or just the Russell 3000, of that 5% differential for this period, you could probably knock off 2%. So it's basically, it would be a 3% differential net of fees if you just looked at US stocks. But again, that's really an unfair comparison because the content of private equity, if you diversify, the content of the indices, the private indices is 30%. I mean, we measure it on both a technical during a regression analysis, but also we look at it on a fundamental basis, what the non-US exposure is. So, if you want to compare it to the best performing index, global equity index, the S&P 500, you can knock 2% off.
And if you compare it to the Russell 2000, it looks a lot better, right?
Yeah, correct. Russell 2000 has been a laggard over this period. It'd be about the same, I think.
Yeah. So a couple related questions as it relates to the historical, call it 3 to 5% net premium of private equity over public. Can you get into a bit of what are the sources of that excess return? Is it strictly an illiquidity premium, or are there other components there, maybe manager skill or alpha that how would you decompose that 3 to 5% in terms of where that added value is coming from?
Well, we don't really know. Okay, there is a premium you pay for publicly traded stocks. Okay, so they're different. Public and private are different in that one has liquidity and one doesn't. And investors who pay for liquidity, okay, that seems to make sense. How much do they pay for that liquidity? So we've seen this in private debt and real estate as well. But basically, it looks like, based on the studies, that at least the ones that I think are credible, 2% is probably the number. So, and that manifests itself in lower entry multiples, EBITDA multiples, private versus public. So I think probably a third to a half of that differential is due to a liquidity premium or liquidity discount, if you will. The other is we're just not sure. Most people, there's an argument to be made that private companies, particularly private equity companies, have an advantage on publics in a number of respects. One is governance, okay, and I think that plays a big role. They have much more an investor focus vis-a-vis publicly traded companies, and that really manifests itself because capital formation in private companies has to be distributed to the investors. They're not evergreen. Private equity firms generally are not evergreen, at least during the time that private equity sponsors are owners. So there's a real focus on return on equity generating cash flow to return to investors that you don't see in publicly traded companies. That is, I think, pretty substantial. It's hard to discern I attach a number to it. I haven't seen a good study that attaches a number to that argument. The other is you probably just have better management. Okay, the incentives, the alignment of interest are such that it attracts better management, and that can be a significant contributor to superior private equity returns. Just one more thing I might mention: there are a lot of poorly managed, bad public companies. Okay, they seem to continue to. They don't go away. They seem to continue to exist. Poorly managed private equity companies, something's going to happen fast, and it's probably part of this is you get the private sector gets rid of its problems quicker than the public sector.
So next question, you briefly touched on at the end in the last slide, the thought around international stocks and value trap versus value. For those that maybe weren't on last quarter's webinar where we did dive deeper into this topic, can you maybe elaborate a bit more on your thinking around international stocks and public markets?
Well, probably in terms of explaining performance over the last 25 years, particularly different performance levels, the biggest factor has been your allocation to U.S. versus non-U.S. stocks. Okay, there's almost a 5 to 10, depending on your strategy, a 5 to 10% differential return in U.S. versus non-U.S. stocks, and people look at PE ratios and say, "Oh, gee, I got 20 plus PE ratios on U.S. stocks, and I got 10." Maybe 10 to 15 non-U.S. stocks. Oh, non-U.S. stocks are a great deal. They're half price deal. But on my last, I went through, and you can always go back to the webcast last quarter, but I showed growth rates, earnings per share growth rates. And the earnings per share growth rates are much lower outside the U.S. Than the U.S. And that the PE ratio differential is fully explained by the differential in earnings growth. So basically, I call it a value trap because you're just looking at one statistic. You're looking at PE ratios or dividend yields, and you're not looking at earnings per share growth rates. And if you look at the totality, U.S. stocks are what I would say, at least at a minimum, they have the same expected return as non-U.S. stocks. And the other point I made last quarter was diversification. Basically, there is no diversification. Everybody talks about international diversification, but when the U.S. market goes risk off, the global market goes risk off. So I just don't. I mentioned John Bogle 25 years ago said, "Hey, you really don't need to diversify internationally," even though that was a big business for them, and he's been proven more than right. So,
going back to private equity for a minute, question related to we now have one rate cut behind us, several more expected ahead. I think the high rate environment for a while had really kind of stifled M&A and deal activity in the PE space. How do you think about the new vintages coming to market, and should that bode well for PE investments? And when I read this question, I kind of thought a little bit about your paper earlier this year called Vintage Voodoo. So maybe just some guidance or thoughts around how to think about vintage timing or vintage allocation for someone who's trying to build and manage a private equity portfolio.
Yeah, a couple things. So I think the current valuations have built in rate cuts. Right now, the forecast really in a year from now, year and a half from now, rates are going to be, arguably 3 to 3.5%. So current valuations have baked in these rate cuts. So vintage diversification. So let me talk about that. And my point was with this vintage voodoo paper I talked about, there's not a lot of difference in performance amongst private debt vintage years. If you're trying to, you can be frustrated, extremely frustrated if you try to do that in private debt. In private equity, yeah, there's more variability in vintages, particularly when you're looking in the rear view mirror. But the problem here is twofold. One is, it is important, and you saw that in an earlier graph, to select top GPs. Okay, there are bad or weak private equity, and there are strong. And basically, you got to go with the vintage years that the strong GPs are issuing in. That's really number one. You can't, it's much more important than trying to time vintages. Secondly, when private equity might look attractive, a vintage year, hey, the stocks are depressed, may look like a good time to do distressed or kind of a value-oriented PE strategy. The manager you want to invest with may not be raising money at that time, or generally stocks are down and you may not have the liquid assets to reallocate. So we've been preaching this for 45 years. Find good GPs, find good managers, allocate to them consistently over time, and you'll average out variation in vintage performance, but it's very unlikely that you can hit the bottom of the market consistently. And also, when you allocate to these, particularly private equity, it's not like your money's getting invested into that vintage year. It's going to be invested over 3 to 5 years. So basically, you got to forecast, 3 to 5 years out, which is I believe that's impossible.
So private real estate kind of sticks out like a sore thumb in that there hasn't been that historical premium versus its public counterpart like we've seen in credit and equities. What do you attribute that to? Is it merely like sector differences, i.e. more office within the private index and more data centers and the like inside of the public REIT index? How do you think what's the rationale for that?
I attribute it to governance myself. That's been my conclusion. So basically, the public, REITs have much better governance. Okay, first of all, they have to like 40 Act funds, they have to distribute their cash flow. Okay, and so basically, earnings are all distributed, so they constantly have to go back to the capital markets. Okay, to get their capital. And so I just think the governance picture is so much better for REITs than it is on private real estate. That may be changing with these private REITs that have a wealth focus, where management has gotten off the buy and hold forever routine and has moved into trying to be more shareholder focused. So maybe that'll change, but that's what I attribute the similar results to.
Okay. I think we'll get one more question here, unless anyone else has any other last minute ones that they want to toss in, but maybe a place to wrap up here. So, Steve, you've spoken before about kind of index and go passive where markets are efficient and focus on manager selection in areas that were not. Specifically to the U.S. stock market, when you look at the concentration of stocks within the S&P, for example, I think it's like 35 or something percent in the top 10 names. Does that concern you at all in terms of over concentration in the indexes these days?
No. Hey, it'd be better if it was much more dispersed, but basically the U.S. market's a growth market, and growth can be concentrated as it is currently, as it has been in other sectors historically. So it basically means that it's probably going to be more volatile. But capital formation in the U.S. Just seems to be concentrated in IT and a few other sectors, and so that basically doesn't bother me. I would try to achieve diversification just by adding other asset classes to diversify against U.S. stocks and their concentration, and that's why we like private debt and private equity. It seems to me to be a better diversifier than trying to, let's say, equal weight the S&P 500 or invest outside the U.S.
Great. Well, great place to stop. Steve, thanks as always for your insights today. Thanks to all of our attendees for taking time out of your day to join us. We look forward to seeing you next time and hope you have a great rest of your day and week. Thank you.
Thanks, everybody.